In this video, we're going to go over a few profit and loss diagrams for call and put options. So this is going to be very much a beginner-friendly video looking at some profit and loss diagrams. And what we're going to do is run through an example of a call option where we're going to buy a call option, we're going to sell a call option, and we're going to buy a put, and we're going to sell a put. And within the example, we're going to run through the different scenarios and then chart them on a profit and loss diagram. I think this is really important for you to be able to do. You should be able to sort of draw these out yourself for better understanding. Personally, I'm on this journey of becoming a full-time day trader. We are studying options, and I've seen these profit and loss diagrams quite a bit in various introduction to option videos and material that I'm studying from. So now is a good time to actually get a handle on exactly how to create these, what they represent, especially when we move on to the next stage where we're looking at some strategy with options and some option spreads. It's really good to really have a good understanding of exactly how these profit and loss diagrams work. Now that we have a good sort of understanding what options are, buying options, selling options, and then we've talked already on this channel about some components of option prices, and we've talked about the Greeks as well. And now it's sort of good to look at these profit and loss diagrams because we've got a good sort of base foundation of knowledge about options. Now we can sort of draw these out and really understand them. So certainly check out all the prior videos about options. You can find those below. And once you've gone through those, I think you're ready to sort of run through these profit and loss diagrams. So let's get right into it. And we're going to start with a long call option. So again, we're buying a call option, a long call, buying a call. It means the same thing. And again, when you buy a call option, you have the right to buy the underlying stock at the strike price before the expiration. So what we want in this scenario as a call buyer is we want the stock to go up. Now, with long calls, when you're buying a call option, what's great is you have the right, but you don't have any obligation. So your losses are going to be capped at the premium that you paid. So the premium is what you pay to buy the option, which gives you the right to exercise it at the strike price. And again, that's the most you can lose when you buy an option. So for this example, we're going to pretend we have a strike price of $50. And the premium that we paid is $5. So again, for options, there is an option multiplier. It's usually 100. So this will give us the right to buy 100 shares at $50. So the premium paid is $5 per share. So really, this would cost you $500. But we're just going to focus on the $5 premium for this example with the profit and loss diagram. Okay, so that's the example. We have a strike price of 50 and we've paid $5. So we paid $5 for this option to have the right to buy the stock at $50. So the profit and loss calculation for this long call, and when we run through the example, we'll see it make a bit more sense. It's going to be the stock price minus the strike price minus the premium that you pay. So obviously, when the stock price goes higher, you will receive more profit. So if the stock price, is at $100 minus the strike price minus the premium, you're up $45 there. And then the loss is going to be capped at $5. So if the stock price is, way down at $10 and you have the right to buy it at 50, you would never ever do that. You would never buy a stock at $50 when it is selling at the market for something less. Therefore, the loss is just going to be the premium that you paid. That option would expire worthless and you would just lose the $5. So if we run through the examples here with the stock price at 30, the profit or loss, it's going to be a loss of your $5 premium. So that option is expiring worthless and you lose the $5. When it's 40, the same thing, the max loss is going to be $5. When the price is 50, the max loss again is going to be $5. So this is when the stock is at the money. So the stock price is 50, the strike price is 50, so that's 0. So maybe we'll just draw that out for that particular example. So for this one, at the money, that's going to be, the stock is 50, the strike price is 50. So we're going to lose $5. So again, your max loss is going to be $5 there. So 50 minus 50, is 0. Minus 5 is minus 5. So at $50 at the money, you are still going to lose the premium because you would not exercise that option. But now when the stock price gets up to 55, this is our break-even point. The strike price, so for this example, it's 50 plus the premium is 5. That's going to be 55. So the break-even price is 55. And if you think about that, you have the right to buy the call option at $50, but you paid $5. So if it's $50 and you exercise that, therefore, you have the right to buy at 50, and the stock price is currently 55. So you can buy at 50 and sell at 55. So you're up $5. However, you paid $5 premium there. Therefore, you would break even. And then if we move on to $60, so now the stock price is rising, we've got some profit here. We've got, $60 minus the strike of 50. So we're up $10 there, but we paid $5 premium. So we are up $5 for this particular stock price. So when the stock price is rising, now it's $70. Now we've got a profit of 15. We can buy at 50, sell at 70. We're up $20, and we paid $5 for that. So it's going to be 20 minus 5 is going to be 15. So we're up 15. So that's just sort of a quick discussion and run through of these various scenarios. So now we want to chart these on a diagram, which makes it really easy to visually sort of understand. So on the y-axis here, this is going to be your profit and loss, and we'll mark it off 0 here. So anything above the 0 line is going to be positive, and anything below is going to be negative. And then on the x-axis, we have the stock price. So this is going to be the stock price. So that is what the axis is, the x-axis and the y-axis, the axi are for a profit and loss diagram. On the x-axis, you have the stock price, and on the y-axis, you have the profit or the loss. So what we can do now is we can just plug in these numbers and see where they land on this particular diagram. So if we go here and we'll go a stock price of 30, with a stock price of 30, the profit and loss is going to be -5. So we'll go down here and we'll plug in a -5, and we'll plug in a little dot there. So at 30, we lose $5. At 40, we lose $5 as well. At 50, we lose $5 as well. At 55 now, we have a break even. So at 55, we have a break even. So we have 0 here. So that is going to be our spot for that one. And at 60, we are up $5. So at 60, we are now up positive $5. So at 60, we're up 5. And at 70, we're up 15. So at 70, we're up 5, 10, 15. And now we can draw this profit and loss diagram. We can connect the dots. So we connect the dots here, and we go up to the right. And now we have a profit and loss diagram. So what does this tell us? This tells us that right at 55, the profit and loss is going to be 0, and that is our break even point right there. And it tells us that as the stock goes below 55, we are in a loss territory. So at 50, we're down there we're at -5, and that's where we saw it there. When the stock is $50, it's going to be out of the money. We're going to lose. When the stock's at 40, it's out of the money. We're going to lose. But the most that we're going to lose, our max loss, is going to be the premium that we paid for this, because we are buying a call option. So the max we lose is -5. And theoretically, we can continue moving to the right as the stock price goes up. So when the stock price is $70, we have a gain of 15 with this option. So remember, when the stock price, 70 minus the strike price of 50 minus the premium paid, and we are plus 15. So we've got a profit there. So this is what this diagram shows, that we have limited losses at -5. That's the maximum we can lose, because that's the premium that we paid for this option. And then up and to the right, this is showing you the profits of this option. As the stock price rises, your option becomes more profitable. That's what happens with a call option. You want the stock to rise because you have the right to buy at the strike price. Anything above that strike price is going to be profitable. It's going to have intrinsic value as long as it's above what you paid for it. So, 54, you're still going to lose because you had to pay $5 for that. But when it's at 55, or as soon as it's 56, you've got $1 of profit there. And as soon as you rise to 60, you've got $5 of profit, and so on. So this is the profit and loss diagram. And again, mine's a little crooked there. When you see them on other presentations, they're nice and straight. It's going to show you the max loss, and then up and to the right for a call option. So you can tell that a few things. Where this sort of hockey stick intersects with the x-axis, that is going to be your break-even point. And right here, where there is a bend, that is going to be your strike price. So, my diagram is not super straight, but if we chart this all the way up, that's right at 50, and 50 is, the strike price for this particular option. So that is something that you can tell when you're looking at these diagrams. The bend right there is going to be the strike price. Where it intersects the x-axis is going to be the break-even. And then you can see that this is up and to the right, meaning it's a bullish strategy. The call option is bullish to the right. So as the stock price rises, you will earn money. That's bullish. That's a bullish strategy. As the stock price goes up, this option receives greater profit. So that is bullish. So now when we look at the other different scenarios, now when we sell the call, we can put ourselves in the shoes of someone who is on the other side of this, and we can see how the diagram is going to be different. So now let's go and look at what a profit and loss diagram is going to look like if we are selling the call option, and then we'll look at the put options. So let's do that now. Okay, so selling a call option is the same thing as shorting a call option. So if you short the call, you are now the person who sold the call option. And remember, now you have the obligation to sell the stock at the strike price if the call buyer exercises it. So the example we just did, you have the right, when you buy a call option, you have the right to buy at the strike price. And now we need to flip it around and look at it from the perspective of the person who sold that call option to, we might have to sell the stock at the strike price if that person exercises the option. So we are obligated to sell if the person exercises the option. So for this scenario, for a short call, the maximum that you're going to gain is the premium that you received for the option. So again, you sold the option, and that is going to be the max that you received. And that's going to be your max profit, is going to be whatever you sold it. So for the example, let's look at the same numbers here. We've got a strike price of 50, and the premium that we received is going to be $5, or $500 at $5 per share. So the profit and loss for selling a call option is going to be, your premium minus the difference between the stock price and the strike price. So if we just look at this formula here, if the stock price goes up, that's not going to be good for us because we are going to lose. So we want the stock price and the strike price to either be the same, or we want the stock price to go down. So if you are selling call options, you want the stock price to remain the same or go down. So it's sort of a bearish strategy. And then what you're going to do is just keep the premium. So if we look at various stock prices, we can analyze what the profit and losses might be. So if the stock price goes all the way down to 30, that is going to be great for us if we're selling call options, because the option is going to expire worthless, and we're going to keep the $5 premium. And again, if the person on the other end, if the stock price is 30, you have the ability to buy at 50, you would never do that. The option for you would expire worthless. And as the seller, you're just going to keep the premium. So that's great for you. If the stock price is 40, again, it's less than the strike price here, you're going to win. You're going to gain that $5. At 50, with the stock price is 50 and the strike price is 50, that's going to be 0. So your premium is going to be still what you receive. So that's great. And then at 55, that's our break even. So at 55, you're going to break even on this transaction. And now what we can see is that as the stock price moves up, we are going to start to lose some money here. So when the stock price is 60, the strike price is 50, and our premium was 5, we're going to be 10 here, and we're going to be 5 minus 10. So we're going to be -5 in this example. And as the profit rises to 70, if we take this again, we're going to be a premium of 5, and we're going to have to minus, the difference between 70 and 50, which is 20. So we are going to be down 15 there for when the stock price rises to 70. So again, the break even is going to be the strike price plus the premium received. So that is going to be, at the 55, it's going to be the strike price of 50 plus the $5 premium. So that's going to be your break even. So let's chart these out on a profit and loss diagram, and you can see how the diagram is going to look differently for these scenarios. And if there's any background noise, it's because my dog is making noise on the chair right beside me. So the profit and loss, and we've got profits here and losses down here, and here it's 0. We have the x-axis, and this is going to be our stock price. So at 30, let's check out what that is. So we've got 30 here, and we have a $5 gain. So we're up $5. And when the stock price is 40, we are up $5. And when the stock price is 50, we are up $5. And at 55, we are right here breaking even. And at 60, now we are -5. So we're -5 right here. 60 and -5. And at 70, we are -15. So we are down there. So if we connect these dots now and draw that out. Okay, I totally missed that there. Sorry about that. But now we can see what this is telling us. So again, so what this is telling us is that the max gain that we can get is sort of in this area here. and that's going to be $5. So the maximum that you can gain when you sell an option is going to be the premium that you received. And we received $5, and we can get that when the stock price is, $50 or less. And then it showed us that right here at 55, and I know my diagram's a little off there, sorry about that. That is the break even point for this option. So at 55, you would break even from this option. And then as the stock price rises, our profits are going down. And as the stock price rises, theoretically, this can keep going down and down. And that shows that this is a bearish strategy for a call seller. We want the stock to basically stay the same right at the strike price or go down for us to gain the premium. And if it goes up, then we are in loss territory. And if you think about this, if the stock price goes up to 70 and we sold that option, we are obligated to sell at 50. The person on the other end has the right to buy at 50, and the stock is currently selling for 70. That would mean we would be at a loss. We'd theoretically have to buy. We'd have to buy at 70 and then go and sell to the option holder who exercises it at the strike price of 50, because they have that right. So this is the profit and loss diagram for a call seller. You have $5 in profit there, and that's your sort of max. And as the stock price rises, your profit and loss diagram slopes down to the right, meaning you are losing as the stock price rises. And if we just kind of scroll up to our first example, it's sort of an inverse relationship. We've got -5 and up to the right for buying, and for selling the option, it's the diagram, but it's flipped. We have a $5 premium that we will collect as the stock price goes down, and that's the max we're going to gain from selling the call option, and then we lose as the stock price rises. And that is a profit and loss diagram for shorting an option or shorting a call option, selling a call option. So now let's look at a put option. So we're going to do the same thing for buying a put option and selling a put option. So we'll start with long put option. So that's when you buy a put option. So again, this one is going to be bearish. So if you can remember, with a put option, you have the right to sell the underlying stock at the strike price. So what you want to do is ideally you want the stock to go down. So for this example, we've got a strike price of $50 and a premium that we paid of $4. So we have the right to sell at 50. So if the stock price drops to 30, then we can buy at 30 and sell at 50 and make a profit there. So we want the stock price to fall. That is a bearish strategy, and that is what happens when you buy a put option. So for this particular one, again, with put options, you have the right, but not the obligation, to sell the stock at the strike price. So the maximum that you can lose when you buy a put option, again, is going to be the premium that you paid. So the max we're going to lose here is going to be $4 per share, so $400 for the entire contract. And then the profit and loss formula for a put option, when you buy one, it's going to be the strike price minus the stock price minus the premium. So we can also look, the break even is going to be the strike price minus the premium paid. So if we just look at a few of these examples here, so with a strike price of 30, we have a profit of 16. So as the price goes down, we are going to gain here. And if we kind of just look at this, the strike price is 50 and the stock price was 30 in that example. So we minus the premium and we have 20 minus 4. So our profit is going to be $16 when the stock price goes down. So that is going to be a bearish outlook here. And when the stock price is 40, we still have a profit, but it's a little less. It's 6. And then the break-even point is going to be at $46. So at 46, we have a break-even because our strike price is 50 minus the premium that we paid. So right at 46, this would break even. And then as the stock price goes higher, we are going to have our max loss of $4 because the option is going to expire worthless. And if we just stop and think about this, we have the right to sell at 50. If the stock price rises higher, we would not, buy at 60 and then flip around and exercise our option to sell at a lower amount. So this option would expire worthless, and we would just lose the $4 of premium that we paid. So let's chart this one on our profit and loss diagram. So this is our profit and loss, and we've got profits there on the y-axis and losses down below. And right here we've got 0, and we've got our x-axis. And again, this is the stock price. So stock price on the x-axis, and then profits and losses on the y-axis. So for a $30 stock price, we saw profits of 16. So we were up here at 16, and we'll chart that there. And with a stock price of 40, we saw profits of 6. So put 6 there. And at 46, so at 46, this was our break even. And at 50, we have a max loss of -4. So we've got -4 here at 50. And at 60, we've got -4. And at 70, -4. And again, -4 is going to be the max that we will lose with this option because we are buying the put option. So the max we're going to lose is the premium. And the diagram is going to be up and to the left. So right away, when it's up and to the left, that is a bearish strategy. And again, when it intersects the stock price and the x-axis here, that is going to be our break-even point. So we saw that $46 was the break-even. Again, we have the right to sell at 50, but we paid $4 for that right. So basically at $46, that is going to break even. And then anything less than 46, we are starting to earn a profit. So at $40, we earn a profit. Our strike price is 50. Our stock price is 40. And our premium was 4. So we've got 10 minus 4. We've got $6 of profit there as we own the option to sell at 50. So that is depicted right there. And again, anything to the left is if we charted this and the stock price went down further, theoretically, if the stock went all the way to 0, that would be, what we can gain as we short the stock or as we have a long put option. So when the stock price drops, we can see our profits are going up. So it's a bearish outlook there. And again, right here at 50, where the hockey stick sort of starts to go up, that is going to be, indicated by the strike price. So whenever you look at these diagrams, the strike price is right at the hockey stick where it intersects the x-axis. That's our break-even point at 46. And then up and to the left, all of this is profits. And that is what happens when you have a put option. You have the right to sell at a strike price of 50. And if the stock price is less than that, you are going to be profitable. So that is the profit and loss diagram when you buy a put option. So the last one is now we're going to flip it and we are going to be short the put option. So now we've got to put ourselves in the shoes of the person who is selling the put option. So when you short a put option, you are selling the put option. And for this particular one, the max that you're going to gain is going to be the premium that you receive. So for this example, we've got a strike price of 50 and a premium there that you received was $4. So again, if we kind of think about this, we want the stock price to basically stay the same or go up. And that way the option is going to expire worthless and we're just going to keep the premium. So when we chart this out, we can kind of say that again and see it when the chart is there. So the profit and loss for selling or shorting a put is you're going to get your premium minus the difference between the strike price and the stock price. So the strike price here is $50. Right? So that's our strike price is 50. So as this goes higher, that's great for us because, if this is, 51, then this is theoretically, this is 0 and your premium is what you're going to keep. So we want the stock price to go up when we sell a put option. Again, we are obligated to buy the stock at the strike price of 50. So we want it to go higher so it will expire worthless. So if we look at the stock prices here, when the stock price is 30, we have a loss of 16, and we can kind of see that there. The premium is going to be $4, and then we're going to minus. If we have a strike price of 50 and the stock price is 30, we're going to go 4 minus 20, and we're going to be down 16. So when the stock price goes down, that's not good for us as the short put seller. And again, stock price 40, we lose 60, and the break even is there going to be at 46. So the break even 46 is the strike price minus the premium. Okay, so that's the 46. And again, anything higher than 50 there is great for us. So when the stock price rises, the option expires worthless. The put buyer is not going to exercise that option, and we're going to gain $4, and that's going to be the max that we gain. So if we chart this out on our profit and loss diagram, here we've got profits, we've got losses down here, and right there at 0, we've got our stock price, and at 30, when the stock is 30, what happens to our profits? We are down 16. So we'll call it, negative 16 right there. And when the stock price is a little higher, at 4, we are at negative 6 right there. And when the stock price is 46, that's our break even. And when the stock price is 50, we are positive 4. And when the stock price is 60, we are positive 4 because that's the premium. So we can't make more than the premium. And at 70, it's positive 4. Okay, so that would go all the way to the right. And we come down in the break even. And this is losses. So if we look at this diagram here, this is positive 4. So positive 4 is going to be sort of the maximum that we can gain is the premium that we received when we sold this put option. And we can see here right at the hockey stick where it bends, that is our strike price, right? So the hockey stick bends right at the strike of 50. And that's our strike price of 50. And it's going to intersect. And that's going to be, remember, that's going to be our break even. And our break even was there at $46. And then as the stock price drops, we lose. So at $40, we're down $6. At 30, we're down 16 and we're losing. And if you kind of can think about that, we have the obligation to buy at 50. So if the stock price is 30, we would have to, we're obligated to buy at the strike price of 50. If the, the stock price is 30 and we have to buy it at 50, we buy at 50 and then we want to sell it at the market for 30, we are incurring a big loss. there. So as the stock price goes down, we lose because we have the right we've got to buy it at 50. That's what the contract says, but the value of it is less. So therefore we are losing because we are obligated to, buy at 50. That's what is in the contract. So we would lose there. So if we sort of just kind of look at the diagrams here, as we scroll up to the selling, we can see that basically the diagram is flipped. So there's when you're long, you want the stock to go down. That is good for you. And if you are selling, you do not want the stock to go down. You'd like the stock to stay the same or go up, and you will just gain the premium when you sell. Here, you want the stock to go down because you have the right to sell at 50. And if it's less, then you can buy it at 30 and sell at 50. So you gain there. And then if we go back to the call option, long call, you want the stock to go up. You have the right to buy at 50. And as the stock goes higher, you can buy at 50 and sell it at the market for higher. And here are all your profits. And the max you're going to lose is going to be, what you paid for the option at $5 there. So that's going to be your max loss. Okay. So if we sort of just review all these now, we've got a call option. So you're buying a call option with a strike price of 50. So that gives you the right to buy the underlying asset at $50. If the stock price is at 55, you would break even because it cost you $5 for that option. And anything above, you are making money because you have the right to buy at 50 and the stock price is at 60 or 70. You've got profit there. If the stock price falls, the most you would lose is the premium that you paid, which is $5, because you would just let the option expire worthless. Now, if we flip around and we look at the point of view of the seller, the max that you're going to receive, is the premium that you sold the call option for. So that's going to be $5. So the max profit here is $5, and that's why this line is capped there. And right at the point here where we see the hockey stick down to the right, that's going to be the strike price of 50. And at 55, it's going to break even. Anything above 55, you are looking at some potential losses here because you are obligated to sell the stock to the call buyer at 50. And if the option or if the stock is $70, you might have to buy at 70, flip around and sell at 50, and you are, incurring a loss there. And that is shown in this profit and loss diagram. So the break even is 55. Strike price is where the hockey stick starts to go down. The max profit you get there is the premium that you sold it for. So you want the stock to either remain the same or go down when you're selling a call option. And then for a put option, remember, you have the right now to sell at $50. That's your strike price. So you are profitable when the stock goes down because you can buy at 30 and sell at 50 theoretically. So there's a profit there. Your break even is going to be right at 46, where you look at the strike price minus the premium that you paid, and the max loss that you're going to get here is $4 because you're buying the call option. You don't have any obligations. You have the right to sell at 50, but if the stock price is higher, then you certainly wouldn't go out and do that. If the stock price is at $60, you have the right to sell at 50. You would not buy at 60 and flip around and sell at 50. That does not make financial sense. So your option would expire worthless and you would just lose the $4. So your max loss is $4 and you gain profit as the stock goes down. That's what's shown through this, bearish arrow to profits to the left. So that's bearish. Break-even point is where it intersects at 46, and the strike price is always when the diagram has that hockey stick right at $50, and that's the strike price. And then if we flip it and we're talking the short, so you are selling a put option here, so you are obligated to buy these shares at 50, and the premium that you're going to get is $4. So the max profit that you're going to get is $4, and you want the stock to stay the same or go up. And as the stock price goes down, that is not good for you because you are obligated to buy at 50. And if the stock price is at 30, that is not an ideal situation for you. You're going to basically lose as the stock price goes down. So the strike price is, again, right here where our diagram starts to go down. Oops. And it break even at 46 there. The most you can win, the most you can profit is what you sold the options for, but you do have some potential losses that can continue as the stock goes down. So this is a riskier position, and you can see that that is what happens for selling put options. So I hope that you found this useful, sort of a messy diagram. But if you can sort of take these different scenarios and draw these out and become comfortable, the more that you do this, I think it's going to be beneficial as soon as you start combining these various options through what's called an option spread. So, you've got, you're buying call options with different strike prices. And when you start to plot those out, if you don't have a good foundation of just these basic profit and loss diagrams with a simple call or a simple put, then you're going to get confused. And at this point, wherever you are in your options journey, you certainly want to have a good base and a good understanding of what these diagrams mean, how you can chart them out yourself. That's going to be helpful as we get into more strategy discussions of options. So I hope that you found this useful. You can subscribe to the YouTube channel. You can find all our related option videos as well. So thanks so much for watching. Take care.